Imagine a captain of a ship. He is in the middle of the ocean. The engine is running, but he decides he wants to go faster. Not by adding better fuel. Not by upgrading the sails. But by tearing up the floorboards of the deck and throwing them into the furnace. The ship speeds up for a moment. The passengers cheer. The investors on the shore see the ship moving faster than ever. But slowly, the structure begins to rot. The hull weakens. And eventually, when the storm comes, there is no ship left. This is exactly what is happening to the American economy right now. It is not a metaphor. It is a mechanism. It is called the corporate buyback. And for the last 40 years, it has been the single greatest tool for transferring wealth from the workers and the future of this country directly into the pockets of a tiny elite. They tell you it's efficient. They tell you it's just returning value to shareholders. But looking at the data, looking at the collapse of American innovation, it looks a lot less like finance. And a lot more like looting. We are going to walk through the 4 stages of this machine. We are going to show you how the backbone of American industry was hollowed out, sold off, and turned into a financial casino. This is the story of the hidden bailout. Before we descend into this rabbit hole, I need you to make a choice. If you want to stay blind to how the economic engine is being rigged against you, click away now. But if you want to understand the mechanics of the world so you can protect yourself and your family from what is coming, you need to be here. Hit that subscribe button. Turn on the notifications. And leave a comment below. Tell me, do you feel like the economy is working for you, or do you feel like you are servicing a debt you never signed up for? Let's get into it. To understand the crime, you have to understand the law. And for a long time, what is happening today was actually illegal. Go back to the post-war era, the golden age of American capitalism. General Electric, General Motors, IBM. These companies were fortresses. When they made a profit, that money had a destination. It went to 3 places. 1. Higher wages for the workers who built the product. 2. Research and development to build the next product. And 3. A rainy day fund, to survive a recession without begging the government for help. But there was one place the money did not go. It did not go into buying back their own stock. In fact, before 1982, stock buybacks were essentially considered market manipulation. The Securities and Exchange Commission, the police of the financial world, looked at buybacks and said, if a company buys its own stock, it is artificially inflating the price. It is rigging the scoreboard. It creates a fake signal of demand. So, CEOs didn't do it. They feared going to jail. But then came the 1980s. The era of deregulation. The era of greed is good. In 1982, under the Reagan administration, the SEC passed a quiet little rule called Rule 10b-18. It sounds boring. It sounds like paperwork. But Rule 10b-18 was the gun that killed the old American economy. This rule created a safe harbor. It told corporations that they could buy back their own shares without fear of being prosecuted for market manipulation, as long as they followed a few loose guidelines. Suddenly, the handcuffs were off. The taboo was broken. And the floodgates opened. In 1980, corporations spent almost 0% of their profits on buybacks. Today, that number is often over 100%. That means companies are spending more money buying their own stock than they are actually earning in profit. They are borrowing money just to do it. Why? Why would a company eat itself? Why would a captain burn his own ship? Because the incentives changed. And this brings us to the first stage of the redistribution machine. Earnings extraction. This is the foundational step. You need to understand how a modern CEO thinks versus how a CEO thought in 1960. In 1960, a CEO wanted to build an empire. He wanted a factory that would last 50 years. He wanted his legacy to be a product that changed the world. Today, the average tenure of a CEO is about 5 years. He doesn't care about 50 years from now. He cares about the next 4 quarters. He cares about the stock price right now, because that is how he gets paid. We will get to the compensation package in a minute, but first, look at the mechanics of the extraction. When a company buys back its stock, It reduces the number of shares available in the market. Imagine a pizza cut into 8 slices. If you take away 4 slices, the remaining 4 slices are bigger. The pizza didn't get bigger. The company didn't make more money. The company didn't sell more products. But because there are fewer shares, the earnings per share, the holy grail of Wall Street, goes up. It is a mathematical illusion. It creates the appearance of growth where there is no growth. It is financial engineering replacing mechanical engineering. And the market loves it. The algorithms love it. The stock price jumps. But where did the money come from to buy those shares? It came from the company's treasury. That creates a vacuum. That is money that is now gone. It is not in the factory. It is not in the worker's pocket. It has been transferred to the people who sold the stock. And who owns the stock? The top 10% of households own 89% of all stocks. So, when a company drains its bank account to buy back stock, it is taking the surplus generated by the workers and the consumers, and it is funneling it directly to the asset holding class. It is a direct siphon. This is why you see the stock market hitting all-time highs while the real economy feels like it is grinding to a halt. Because the stock market is no longer measuring the health of the economy. It is measuring the efficiency of the extraction. But you might ask, why would they do this if it weakens the company in the long run? If it leaves the company with no cash for a crisis? Why would they risk the life of the host just to feed the parasite? Because the people making the decisions are the ones holding the spoon. This leads us to the second step of the redistribution. The motive. Also known as executive compensation alignment. This is the smoking gun. If you want to know why a crime happened, you follow the money. And the money leads directly to the CEO's compensation package. In the old days, a CEO was paid a salary. Maybe a nice bonus if he did well. But today, the vast majority of executive pay is in stock options. This was supposed to be a good idea. The theory was, if we pay the CEO in stock, he will think like an owner. He will want the stock price to go up, which is good for everyone. It sounds logical, but in practice, it became a disaster. Because there are 2 ways to make a stock price go up. The hard way, innovate, build better products, treat customers well, and grow the business over 20 years. Or the easy way, manipulate the supply of shares through buybacks. If you are a CEO, and you have a package of stock options worth $50 million that vests in 3 years, which path are you going to take? Are you going to bet on a risky new product that might fail? Or are you going to take the sure thing? You are going to take the company's cash, buy the stock, pump the price, hit your target, cash out your options, and walk away a multimillionaire before the consequences hit. It is legal insider trading. It is price fixing where the fixers get to keep the winnings. There was a study done by the SEC Commissioner Robert Jackson. He looked at what happens after a buyback is announced. He found that immediately after a company announces a buyback, executives sell their own shares. They are selling into the buyback. They are using the company's money to create a buyer for their own personal stock holdings. The company is buying. The CEO is selling. The wealth is transferring. And the company is left holding the bag. This is not capitalism. Capitalism is about allocating capital to its most productive use. This is cannibalism. It is eating the muscle to feed the fat. And it gets worse. Because eventually, you run out of cash. You drain the bank account. But the addiction doesn't stop. The market demands the buybacks continue. The stock price must go up. So what do you do when the cash is gone? You borrow. You go to the bank. You go to the bond market. And this brings us to the third step of the nightmare. Leverage expansion. This is where the risk shifts from the boardroom to the public. This is where the danger becomes systemic. In a healthy economy, companies borrow money to grow. They borrow to build a new factory in Ohio. They borrow to develop a new cancer drug. They borrow to expand into a new market. The debt is an investment. It creates an asset that will generate income to pay off the debt. But that is not what is happening today. Today, corporations are borrowing money to buy back their own stock. Think about the insanity of that. It is like taking out a second mortgage on your house, not to renovate the kitchen, not to fix the roof, but to go to the casino and bet on yourself winning a poker game where you are the only player. Except, in this case, the debt stays with the house. The winnings go to the player. If the company goes bankrupt, the CEO still keeps the $50 million he made when he sold his stock. But the debt? The debt remains attached to the corporation, attached to the workers, attached to the pension funds that hold the corporate bonds. We have seen this movie before, but never on this scale. Look at the interest rate environment of the last decade. We had near zero interest rates for years. Money was free. The Federal Reserve printed trillions of dollars. They said it was to stimulate the economy. They said it was to create jobs. But where did that cheap money go? Did it go to wages? No. Did it go to factories? No. It went into the bond market. Corporations issued record amounts of corporate debt, and they used that cash to repurchase their own shares. They leveraged up the American corporate balance sheet to historic levels. They turned solid, blue-chip companies into fragile, debt-ridden zombies. A zombie company is a company that doesn't make enough profit to even pay the interest on its debt. They are kept alive only by borrowing more money to pay off the old money. And buybacks are the virus that created this zombie apocalypse. When you strip a company of its cash reserves, and then you load it up with debt, you remove its shock absorbers. You make it brittle. In a stable world, maybe you can get away with it. But we do not live in a stable world. We live in a world of pandemics, of supply chain shocks, of geopolitical wars, of sudden inflation. And when those shocks hit, a company with no cash and high debt collapses instantly. This is what happened in 2020. Do you remember the airlines? For 10 years, the major U.S. airlines spent 96% of their free cash flow on stock buybacks. Billions and billions of dollars. They emptied the vaults. They enriched their executives. They pleased Wall Street. And then, COVID hit. Travel stopped. Revenue went to zero. And guess what? They had no money. They had no cushion. Within weeks, they were on the verge of bankruptcy. And what did they do? Did the CEOs return the bonuses? Did the shareholders pay back the money? No. They went to the government. They went to you. They said, "We are essential. You have to save us." And the government did. Billions of dollars in bailouts. Taxpayer money used to refill the hole that the buybacks created. This is the cycle. Privatize the gains. Socialize the losses. When the buyback scheme works, the rich get richer. When the buyback scheme fails, the taxpayer pays the bill. It is a perfect, hermetically sealed loop of extraction. But the damage isn't just financial. It isn't just about numbers on a spreadsheet. The damage is physical. The damage is real. And this brings us to the fourth step, the most tragic step of all. Suppressed investment. This is the invisible cost. It is the factory that wasn't built. The breakthrough that wasn't discovered. The bridge that wasn't repaired. Economists have a term for this: opportunity cost. Every dollar spent on a buyback is a dollar that was not spent on the business itself. And over 40 years, this neglect accumulates. It creates a rust belt of the mind. Look at the iconic American companies that have fallen from grace. Look at Boeing. Boeing was once the greatest engineering company on earth. If it's not Boeing, I'm not going. That was the slogan. They were run by engineers. They were obsessed with safety, with performance, with pushing the envelope of aerospace. But then, the culture changed. The financial engineers took over. The obsession shifted from building the best planes to building the best stock price. Between 2013 and 2019, Boeing spent over $43 billion on stock buybacks. $43 billion. Just imagine what $43 billion could do for safety checks, for training, for engineering new airframes. But instead of designing a new plane from scratch to replace the 737, which would have been expensive and taken time, they decided to patch up an old design. They put new engines on an old frame. They added software fixes to make it fly right. They cut corners to save money. And they used the cash to buy back stock. The stock price soared. Wall Street cheered. The executives got their bonuses. And then, the planes started falling out of the sky. Hundreds of people died. The doors blew off. The reputation of America's premier exporter was shattered. This wasn't an accident. This was a choice. It was a choice to prioritize financial engineering over real engineering. Boeing is not an anomaly. It is the symptom of the disease. Look at Intel. Intel used to dominate the world in microchips. They were the undisputed king of Silicon Valley. But for a decade, Intel management prioritized buybacks and dividends over the incredibly expensive process of developing the next generation of chip manufacturing. They spent billions buying their own stock while their competitor, TSMC in Taiwan, spent billions building better factories. TSMC didn't do buybacks. They poured every cent back into the iron, back into the silicon. And today, TSMC makes the most advanced chips in the world. Intel has fallen behind. The United States, which invented the semiconductor, is now dependent on a foreign power for the brains of its military, its economy, and its future. This is a national security crisis. And it was caused by the buyback machine. We are literally selling our technological sovereignty for a short-term stock bump. We are eating the seed corn. And when winter comes, we will starve. It creates a culture of mediocrity. When you work at a company where the goal is the stock price, you stop taking risks. You stop dreaming. You start cutting costs. You start squeezing labor. You fire the senior engineers because they are expensive. You outsource the critical components because it looks cheaper on the quarterly report. You hollow out the institutional knowledge. And eventually, you forget how to build the thing you sell. You become a hedge fund that happens to make airplanes, or a bank that happens to sell cars. The product becomes secondary. The financial transaction becomes the primary product, and the workers feel it. They see the degradation. They see the lack of investment. They see the old equipment not getting replaced. They see the wages stagnating while the company announces another billion-dollar buyback program. It breeds cynicism. It destroys morale. It breaks the social contract between the employer and the employee. The worker knows the game is rigged. They know they are just fuel for the furnace. And this is why you see the rise of populism, the rise of anger, the strikes, the feeling that the system is broken, because it has been engineered to break. Let's look deeper into the mechanics of how this distorts reality. We talk about the free market. We are told the market is wise, that the market discovers the truth price of things. But buybacks destroy the price discovery mechanism. When there is a relentless, non-price sensitive buyer in the market, the corporation itself, the price creates a floor. It creates a safety net. It dampens volatility on the downside. It makes the stock look less risky than it actually is. It lures in retail investors, regular people like you, with your 401k, with your savings. You see the line going up. You think, this is a solid company. You buy in. But you are buying in at a price that has been artificially elevated by the company's own spending. You are the liquidity they need to exit. The executives, the hedge funds, the early investors, they need someone to sell to. And that someone is the passive index fund. That someone is the pension fund. That someone is you. They are unloading their risk onto the public markets at the exact moment the company is at its weakest fundamentally. It is a transfer of a toxic asset disguised as a blue-chip stock. Think about the retail apocalypse. Companies like Bed Bath & Beyond, Sears, Toys R Us. These companies were raided. Bed Bath & Beyond spent nearly $12 billion on share buybacks over a decade. $12 billion. They could have reinvented themselves. They could have built a world-class e-commerce platform to fight Amazon. They could have modernized their supply chain. They could have pivoted. Instead, they bought back stock. They burned the cash. And when the end came, there was nothing left. The company declared bankruptcy. The workers lost their jobs. The shareholders who held on lost everything. But the executives who ran the buyback programs in the years prior, they did just fine. They cashed out their options years before the crash. They walked away from the wreckage of the car they drove into the wall, and they didn't even have a scratch. This is moral hazard on a grand scale. If you don't pay the price for failure, you will keep taking reckless risks. And the risk is getting bigger. Because now, the interest rates are not zero. The era of free money is over. The Federal Reserve has raised rates to fight inflation. This changes the math of the buyback machine. Remember step 3, leverage expansion? All that debt that corporations took on to buy back stock? It has to be refinanced. When they borrowed the money, the interest rate was 2% or 3%. Now they have to roll that debt over at 5, 6, 7%. The interest expense is going to double or triple. This is the ticking time bomb. The zombie companies are about to face the sunrise, and they are going to burn. The cash flow that was used for buybacks will now have to be used to pay interest. The buybacks will stop. And when the buybacks stop, the artificial support for the stock price disappears. The floor drops out. The elevator cable snaps. We are looking at a potential massive correction in equity values as the withdrawal symptoms kick in. The market is addicted to the drug of buybacks. And the dealer is running out of supply. This isn't just an American problem, but it is uniquely aggressive in America. European companies do buybacks, but not like this. Asian companies rarely do them to this extent. This is a specific pathology of the American financial system. It is the result of a culture that prioritizes short-term financial returns over long-term industrial health. It is the result of the shareholder primacy doctrine. The idea that the only purpose of a corporation is to maximize the stock price for the shareholder. Not to serve the customer. Not to employ the worker. Not to support the community. Just the stock price. And this doctrine has stripped the assets of the nation. It has financialized the economy to the point where the finance sector is the tail wagging the dog of the real economy. We don't make things anymore. We make financial products. We make derivatives. We make debt. And we make stock buybacks. But you cannot eat a stock certificate. You cannot live in a bond. You cannot fight a war with a derivative. Eventually, reality calls. Eventually, you need the factories. You need the engineers. You need the capacity to produce real value. And when we look for it, we are going to find that it has been sold off piece by piece, quarter by quarter, to hit an earnings target that was made up in a boardroom. The geopolitical implications are terrifying. While we were playing financial games, China was building the world's largest industrial base. They were pouring concrete. They were installing robots. They were training scientists. They play a different game. They play for the century. We play for the quarter. And in a contest between the quarter and the century always wins. We are losing our edge not because we lack talent, not because we lack resources, but because we have misallocated our capital on a civilization-ending scale. We took the surplus of the greatest economy in history and we burned it to keep the stock market warm. And now the fire is dying. And we are out of wood. This leads us to the inevitable question. What happens when the music stops? What happens when the corporate sector, loaded with debt and stripped of cash, hits a recession? They will do exactly what they did in 2008. Exactly what they did in 2020. They will turn to Washington. They will say that they are too big to fail. They will say that if they collapse, millions of jobs will be lost. And they will be right. Because they have taken the economy hostage. They have strapped the bomb of debt to their chests and they are holding the detonator. And the government will have no choice but to pay the ransom. Or at least, that is what they think. But history has a way of surprising us. The public tolerance for bailouts is at an all-time low. The anger is at an all-time high. The next time they come with their hands out, the reaction might not be a check. It might be a pitchfork. We are entering a period of extreme volatility. Socially, politically, economically. The The mechanism of the buyback has strained the system to its breaking point. It has concentrated wealth to levels not seen since the Gilded Age, has hollowed out the middle class, and it has left our strategic industries vulnerable. Let's pause and visualize the scale of this theft. Since 2008, U.S. corporations have spent more than $5 trillion on stock buybacks. $5 trillion. Do you know how much money that is? That is enough to modernize the entire electrical grid of the United States. That is enough to eliminate student debt nearly 3 times over. That is enough to build a high-speed rail network across the entire continent. That is enough to fund a Mars colony. It is a staggering amount of potential energy. Energy that could have been used to build the future. Instead, it evaporated. It vanished into the ether of the financial markets. It went into the private jets, the Hamptons estates, and the offshore accounts of the ultra-wealthy. It is a tragedy of lost potential. And the worst part is, it is celebrated. Watch CNBC. Watch Bloomberg. When a company announces a buyback, the pundits smile. Great allocation of capital, they say. Shareholder-friendly, they say. They are cheerleading the demolition of the building they are standing in. They are praising the termites for eating the wood because it makes the sawdust look like snow. It is a delusion, a mass hallucination. And if you point it out, you are called a socialist. Or you are told you don't understand economics. But basic economics teaches that investment drives growth. Savings drive investment. Buybacks are the opposite of savings. They are the consumption of capital. They are the liquidation of the firm. Imagine a farmer. Every year, he harvests his crop. He keeps some corn to eat. He sells some corn for money. But he must keep the best corn to replant for next year. That is the seed corn. If he eats the seed corn, he will be full today. He will be fat and happy. But next year, he will have no crop. He will have nothing. Corporate America has been eating the seed corn for 40 years. And we are starting to see the barren fields. Look at the decay of our infrastructure. Look at the decline in manufacturing wages. Look at the fragility of our supply chains. These are the harvest of a system that prioritized extraction over planting. And the executives know it. Do not think for a second that they are stupid. They are highly intelligent. They know exactly what they are doing. They know the game has an expiration date. That is why they are cashing out. That is why the insider selling is at record levels. They are getting off the train before it hits the bridge. They are leaving you on board. And when the crash happens, they will be watching from their islands in New Zealand or their bunkers in Hawaii. And they will blame it on market forces. They will blame it on the Federal Reserve. They will blame it on the workers. They will never blame the mechanism that made them rich. This brings us to a critical realization. The stock market is not the economy. I need you to internalize this. The stock market is a graph of the sentiment of the asset holders. The economy is your job. The economy is the price of milk. The economy is the quality of the roads. The economy is the ability of a young couple to buy a home. By those metrics, the economy is failing. But by the metric of the S&P 500, we are booming. This divergence cannot last forever. Reality always wins. Gravity always wins. Eventually, the stock market must reconnect with the real economy. And when it does, the adjustment will be violent. We are seeing the cracks already. The regional banking crisis. The collapse of commercial real estate. These are the tremors before the earthquake. And the buyback machine has removed the seismic dampers. It has made the buildings rigid. So when the ground shakes, they will not sway. They will snap. You need to be prepared for this. You need to understand that the wealth you see on the screen is largely phantom. It is inflated by debt and buybacks. It is not based on productive capacity. It is based on liquidity flows. And liquidity can dry up in an instant. So, what is the counter-argument? Defenders of buybacks will say, well, the money doesn't disappear. The shareholders get the cash, and they reinvest it in other, new companies. That's how startups get funded. That is the trickle-down theory. But data shows that isn't really happening. The money tends to stay in the secondary market. It buys other existing assets. It buys real estate, driving up housing prices. It buys government bonds. It doesn't flow efficiently into new venture capital. It circulates within the closed loop of the financial system, inflating asset bubbles everywhere it goes. It creates a wealth effect for the rich, while the real wages for the poor remain stagnant. It drives inequality. And inequality drives instability. History teaches us that when the gap between the haves and the have-nots gets too wide, the system resets. Usually in a way that nobody enjoys. We are pushing the boundaries of social cohesion. And for what? To boost earnings per share by 3 cents? To trigger a bonus clause for a CEO? It is a bad trade. It is a terrible trade for the nation. But it is a great trade for the individual executive. And that is the flaw in the system. The incentives are misaligned. What is good for the CEO is bad for the country. And until we fix that, the machine will keep running. The burning of the furniture will continue until there is nothing left to burn. So, what comes next? Are there laws being proposed? Yes. There is talk of a buyback tax. A 1% tax. A 4% tax. But 1% is a rounding error. It won't stop them. The addiction is too strong. The only thing that stops this is a crisis that forces a rewrite of the rules. A crisis where the government says, no more. Where the bailouts come with conditions. We will save you, but you are banned from buying back stock for 10 years. We will save you, but the equity is wiped out. We will save you, but the executives are fired. That is what should happen. But will it? That depends on the political will. And the political will depends on the donors. And the donors are the ones benefiting from the buybacks. It is a captured system. The regulators are captured. Congress is captured. The media is captured. This is why you don't hear this story on the nightly news. They tell you inflation is caused by supply chains. They tell you inflation is caused by wages rising. They rarely tell you that inflation is also driven by corporations prioritizing profit margins and stock prices over price stability. It is a complex web. But the buyback is the spider at the center of it. Let's break down the psychology of the investor in this environment. You are being trained to be passive. Just buy the index, they say. Dollar cost average. Time in the market beats timing the market. These are slogans designed to keep your money flowing into the machine. Because the machine needs your monthly contributions to provide the exit liquidity for the smart money. When a company buys back its stock, who are they buying it from? Often, it's the active managers. The hedge funds. They sell. The price goes up. The index funds, which have to buy whatever is in the index, automatically buy more at the higher price. The passive investor ends up buying high. The active insider sells high. It is a wealth transfer from the passive middle class to the active financial elite. And it is happening automatically every 2 weeks when your paycheck deduction hits. You are funding the very mechanism that is dismantling the economic security of your country. It is a bitter pill to swallow. But you have to see the truth. The game of number go up has a cost. And we are paying that cost in the degradation of our society. Let's look at the healthcare sector. Big Pharma. We pay the highest prices in the world for drugs. Insulin. EpiPens. Cancer treatments. Why are they so expensive? Research and development costs, they say. Innovation is expensive, they say. But look at the balance sheets. Many major pharmaceutical companies spend more on stock buybacks and dividends than they do on R&D. They are not charging you high prices to cure cancer. They are charging you high prices to buy back their stock. They are monetizing your sickness to boost their share price. It is predatory. It is the financialization of human life. And it is legal. Protected by Rule 10b-18. Protected by the narrative of the free market. But there is nothing free about a market where the players can change the score. where the referee is asleep, and where the spectators are paying the entrance fee for a game that is already decided. This brings us to the concept of hollow corporations. A corporation used to be a community. It had a headquarters. It had factories. It had a softball league. It had a pension plan. Now, a corporation is a legal nexus of contracts. It is a shell. It outsources production to China. It outsources customer service to India. It outsources logistics to a third party. It hires freelancers instead of employees. It owns nothing. It does nothing. It simply manages the flow of money. And its primary goal is to extract that money and give it to the shareholders. It minimizes its footprint. It minimizes its tax bill. It minimizes its responsibility. The buyback is the ultimate expression of this hollowness. It says, we have nothing better to do with this money than to give it back. We have no ideas. We have no vision. We are done growing. We are now in the liquidation phase. And yet, these companies are valued at billions of dollars. They are treated as the titans of industry. But they are not titans. They are vampires. They are sucking the lifeblood out of the legacy created by previous generations. We are living off the inheritance of the 20th century. And the bank account is running low. Look at the grid. The power goes out. Look at the trains. They derail. Look at the bridges. They crumble. Why? Because the money that should have fixed them went to share repurchases. The rail companies cut staff. They cut safety inspections. They made the trains longer to save fuel. And they used the profits to buy back stock. Then East Palestine happened. A toxic chemical spill. A town poisoned. Was it an accident? Or was it the inevitable result of a spreadsheet decision? If you cut costs to the bone to fund buybacks, eventually the bone breaks. And real people get hurt. This is not just about finance. This is about safety. This is about survival. The efficiency they preach is actually fragility. They have removed all the slack from the system. And a system with no slack cannot handle a shock. We are driving a car with no airbags, no brakes, and a tank full of jet fuel, going 100 miles an hour. And the driver is busy counting his bonus money. It is a terrifying picture. But you must look at it. You cannot fix what you do not acknowledge. And the first step is to stop worshiping the stock market. To stop equating the Dow Jones with the American dream. The Dow Jones is a measure of how well the largest corporations are extracting wealth. The American dream is about the ability to build a life. Those two things are now in opposition. For the stock market to keep going up at this rate, your wages must stay down. Your costs must go up. Your safety must be compromised. That is the trade-off. Wall Street profits are your losses. It is a zero-sum game. And they are winning. So, as we move toward the conclusion of this analysis, we have to ask, is there a way out? Can we reverse the machine? Can we ban buybacks again? Technically, yes. It would take a simple act of Congress. Or a simple rule change by the SEC. Repeal Rule 10b-18. Make it illegal again. Force companies to use their profits to build, to research, to pay workers, or to pay dividends. Dividends are different. They reward holding the stock, not selling it. They don't manipulate the price in the same way. If we banned buybacks, the stock market would drop. Significantly. The bubble would deflate. It would be painful. But it would be the pain of a fever breaking. It would be the pain of a junkie going into rehab. It is necessary pain if we want to heal. But if we don't do it, if we keep pumping the drug, then the collapse will be terminal. The dollar itself will eventually come under fire. Because if the only way to keep the system going is to print money to bail out the zombie companies, then the currency eventually becomes worthless. We are walking a tightrope. On one side is deflationary collapse. On the other side is hyperinflationary ruin. And the buyback machine is pushing us off the rope. We have arrived at the final stage. The end game. We have seen the history. From the illegal status of buybacks to the deregulation of 1982, we have analyzed the 4 steps of the redistribution mechanism: earnings extraction, executive compensation, leverage expansion, and suppressed investment. We have looked at the victims: Boeing, the Rust Belt, the innovation sector, and the American worker. We have looked at the beneficiaries: the CEOs, the hedge funds, and the asset-holding elite. Now, we must look at the future. What happens in the next 5 years? We are likely entering a period of secular stagnation combined with high volatility. The Great Moderation is over. The tailwinds of cheap labor, cheap energy, and cheap money are gone. They have turned into headwinds. Demographics are aging. Deglobalization is raising costs. Interest rates are normalizing. In this environment, the buyback strategy stops working. You cannot leverage up when debt is expensive. You cannot squeeze labor when the workforce is shrinking. The trick is over. The magician has run out of rabbits. So, what will corporations do? They will panic. They will merge. We will see massive consolidation. Fewer companies. Less competition. Monopolies strengthening their grip to protect their margins. They will raise prices aggressively. This is greedflation. They will use their market power to extract the last drops of value from the consumer. And they will lay off workers to protect the bottom line. It will be a brutal fight for survival. And the government will be paralyzed by its own debt. The U.S. government is paying over $1 trillion a year just in interest on the national debt. They do not have the firepower for another massive bailout without triggering catastrophic inflation. The safety net is torn. The buffer is gone. You are on your own. This is the sobering reality. But there is power in knowing this. If you know the corporate sector is fragile, you don't rely on it for your safety. If you know the pension funds are exposed, you take control of your own finances. If you know the dollar is being debased to support asset prices, you look for hard assets. Gold, land, skills, community. Things that cannot be printed. Things that cannot be bought back. The era of financial engineering is hitting a wall. The era of real things is returning. And in the era of real things, the buyback is a liability, not an asset. Companies that held onto their cash will survive. Companies that burned it will die. It will be a Darwinian event. The forest fire is coming. It will burn down the dead wood. It will burn down the zombie companies. It will be scary, but it is also necessary. Because after the fire, new growth can happen. Real innovation can return. But we have to get through the fire first. The battle lines are drawn. On one side, the financial engineers, desperate to keep the illusion alive. On the other side, the laws of physics and economics, demanding a correction. You are watching the collision in slow motion. Don't be distracted by the political circus. Don't be distracted by the culture wars. Those are sideshows. The real war is the war on your value, the war on your future, and the weapon is the financialization of the economy. You now understand the weapon. You see how it works. You see who is pulling the trigger. The question is, what will you do with this knowledge? Will you continue to play their game? Or will you start playing your own? The system relies on your ignorance. It relies on you believing that they know what they are doing, that the experts have it under control, that the stock market equals the economy. Once you stop believing the lie, the spell is broken. We are standing at a crossroads. One path leads to a neo-feudalism, where a few giant corporations own everything, and the rest of us are renters, servicing the debt of the elite. The other path leads to a painful reset, but a return to sanity. A return to an economy that builds, that saves, that invests, that rewards work, not speculation. I don't know which path we will take, but I know that the current path is a dead end. The hidden bailout has run its course. The bill is coming due, and we are all co-signers. Look at the world around you with new eyes today. When you see a headline about a stock market rally, ask yourself, what was burned to fuel this? When you see a company laying off thousands of workers, check their buyback history. Connect the dots. See the matrix. The story of the American economy is not a story of free markets. It is a story of capture. It is a story of a heist. And you are the witness. Thank you for watching. If this video opened your eyes, if it made you see the world differently, then I have done my job. This is a war for truth as much as it is a war for money. And we need soldiers in this war. We need people who are willing to look at the hard facts. I want you to think about what we discussed. I want you to talk about it. Share this video with someone who thinks the economy is doing great. Start the conversation. Because the only way we stop the looting is if enough people turn on the lights. We have a lot more history to cover. A lot more layers to peel back. The rabbit hole goes deeper than you can imagine. And we are going to explore all of it, right here. So stay vigilant. Stay curious. And I'll see you in the next video.